Michael Burry is selling it all. Market collapse is coming in 2022. Chaos is taking over stock markets all around the globe. Traders have been in a total panic since last Friday, when a number of leading stocks crashed and oil prices significantly plunged, after a wave of infections caused by a new virus variant was recorded in South Africa and several European countries, leading to another round of lockdowns, travel restrictions, and reigniting concerns about the economic impacts of the health crisis. Welcome to Investor Secrets. Today we're going to talk all about Michael Burry's terrifying warning about the upcoming 2022 market crash. So watch the video till the end, because today's video is going to be the bomb. Now let's get to our topic. The S&P 500 had its worst day since February, as several nations around the globe, including the US, reimposed travel bans from a half-dozen African countries. The sudden uncertainty spooked otherwise bullish investors who had thought that the worst of the health crisis was over. The prospects of new, prolonged, and strict lockdowns disrupting global production have shaken the market, which had seen a robust performance in recent weeks. However, according to some market watchers, this initial reaction was just the beginning of the meltdown. As countries continue to assess the risks of the new variant, volatility will become more widespread and cause even sharper drops. Most investors were pricing the stock for perfection and forgetting about our economic reality. But the day of reckoning seems to have arrived, and they're just realizing that the risks are much more dangerous than they've anticipated. Last Thursday, U.S. stock markets were closed for the Thanksgiving holiday, and on Friday, traders logged out early, which some argue may have contributed to the delayed response compared to other markets around the world. Thin trading over the weekend is also likely to exacerbate the swings throughout this week, but the carnage so far has been considerable. On Friday, the market's decline pushed the S&P 500 down from a record high reached just last week, closing 2.3% lower. The Nasdaq Composite Index fell 2.2%, while European stock markets fell 3 to 5%. In recent months, investors have been mainly worried about supply chain disruptions and shortages of labor and goods, factors that are still fueling inflation growth as the price of everything skyrockets. Central banks have already announced plans to withdraw stimulus to fight rampant inflation rates, which many believed would be the pin to pop the stock market bubble. But the unexpected emergence of a new virus strain has brought their focus back to a problem that never really went away. Of course, as the economic impacts of this variant are just starting to be felt, what happened so far was just the beginning of an intense financial meltdown that is going to result in a massive stock market crash over the next few weeks. At this stage of the bubble, all evidence points that the market has already reached its peak, and from now on, the only way to go is down. It's one thing when a single market indicator, or even a few indicators, show weakness, says John Hussman, president of the Hussman Investment Trust. It can be hard to draw major conclusions from small sets of numbers, but it's a very different thing when dozens of indicators start to issue red flags at the same time, he argues. Across 4 decades of work in the financial markets and over a century of historical data, I've never observed as many historical indications of a market peak occurring simultaneously, Hussman said in a recent note. In a recent interview with Business Insider, Hussman cited some very alarming indicators that expose the conditions are set for a sizable stock market crash. The investor believes that there's no way this bubble can last for much longer, and that future returns will be dismal. Jay Powell talks about transitory, or certainly did for a long time, and got mocked for it because we're watching things that look pretty permanent coming in. David Hunter, the chief macro strategist at Contrarian Macro Investors, outlined in a recent interview. Hunter, just as many other market veterans, including Harry Dent, Michael Burry, Jeremy Grantham, and Robert Kiyosaki, are calling for the biggest stock market crash in world history. He sees that tightening measures will cause stocks to crash to a tune of about 80%, marking the largest drop since 1929. Given that the bubble has been popped and the mounting risks have become too unbearable, the amount of evidence supporting their view is definitely alarming. What markets have gone through so far is just a slight indication of what is coming next. It's safe to say that this is game over. The stock market crash no one thought was possible is already upon us. It's all downhill from here. With all this in mind, are we really crazy enough to believe that this bubble will be supported by artificial money forever? Are we really crazy enough to believe that creating trillions of dollars out of thin air and then dumping all this money into assets that don't increase in utility but only in perceived value is a sustainable and solid foundation for our economy? We all know better than that. A huge stock market crash is fast approaching, and people need to run for the exits before an economic disaster is finally here. Burry in some way is saying he's the financial version of this priestess. He's freely giving out warnings on his Twitter account, but not too many people are paying attention. They're just enjoying the short-term returns that they've had, but let's see who wins in the long term. So I want to dig a bit further into some of the things that he's saying and what we need to watch out for as investors. First of all, we've got to talk about all of these hype groups that we've seen on Reddit, on YouTube, and across the internet. These hype groups that promote certain stocks, and generally high-growth, risky ones, and then a bunch of short-term money gets plowed into them. For example, the recent saga that we've seen on Wall Street Bets with GameStop, with AMC, and all the other ones, we saw these stocks get out of control in terms of price, and people weren't afraid to throw their stimulus checks into them. Were they researching the fundamentals of these stocks? Most, of course, no. Did they understand the risk with these stocks? Most, of course, didn't. They were trying to make short-term, quick money. Michael Burry, who actually invested in GameStop when it was cheap, was not happy with all of this so-called uneducated money going into GameStop. He said, "If I put GME on your radar and you did well, I'm genuinely happy for you. However, what's going on now, there should be legal and regulatory repercussions. This is unnatural, insane, and dangerous." And one of the reasons for this is just because there's so much free money floating around. We've seen the new $1.9 billion in stimulus checks come through. We've seen the Fed keeping interest rates to pretty much all-time lows. This free money, a lot of it is entering the stock market, and a lot of it is entering these so-called meme stocks. Michael Burry clearly doesn't think this is natural or sustainable, and I tend to agree with him on that point. The next thing that Burry talks about that is inflating stock prices is all of this passive investing. As he said, passive investing's IQ drain and #stonks group hype add to the danger. That's all for today. If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comment section down below. See you soon. Bye.